Let's talk a little bit more about the Fed. At his post-Fed decision press conference on Wednesday, Central Bank Chairman Jay Powell spoke about receiving criticism from elected officials.
I'm not going to change my practice here today of not responding to comments or addressing comments made by elected officials. I will just say that I continue to believe that the independence of the Federal Reserve from direct political control has served the public well over time. And I assure you that my colleagues and I will continue to conduct monetary policy without regard to political considerations.
But criticism of the central bank's leadership isn't something unique to the Trump administration. In a Wall Street Journal opinion piece, Princeton professor Alan Blinder lays out the long history of U.S. presidents bashing the Fed. Professor Blinder is with us right now. By the way, we should also mention he's a former vice chairman of the Federal Reserve. And Alan, it's not new to see presidents beating up on Fed chairs, but it is new to see it advertised to the world on Twitter in such a way, right?
Yeah, well, two things are new. People have short memories, and they forgot that this hands-off the Fed policy only began with Bill Clinton. And the point of my piece in the Wall Street Journal was if you look earlier than Bill Clinton, it was one Fed bashing after another. Of course, none of that was on Twitter. None of it was as nasty and personal as what President Trump has been doing to Jay Powell. I mean, he's calling him names like a child on a playground.
And
I don't think you find precedents for that.
Yeah.
What's that?
And a bonehead and a traitor, if you look at
some of the statements. A bonehead, a traitor. Yeah, I mean, all kinds of things. I don't think you can find that in past history.
What do you think of Jay Powell's response to this? He says, look, I'm not going to take the bait.
I think he's treating it with exactly the backbone and the dignity that he should. I mean, it's a real contrast to the president who rants and raves, and Powell calmly says, I have a job to do. The law gives me independence from politics. We are independent from politics, and I'm not going to engage in a tit-for-tat with he usually says the politicians in general. He means, of course, the president, who's the one that's giving
But
the
you're
trouble.
right, Mr. President. And when I said we're a long way from neutral on the low side, I was wrong. And everything you said was right, and I've now cut rates twice.
I wouldn't put it that way. Right. I think the Fed realized at the top they were probably around or above neutral. The estimate of neutral has been creeping down over time, as you know. The Fed is constantly adjusting it to realities. It could creep back up again. There's no theorem or certainty that's always going to stay as low as it is now.
He may have learned a little during the December sell-off, maybe, that something happened. Maybe it was a trade war, but something happened in December.
It's possible. Look, I think, as I said in the Wall Street Journal piece, the case for cutting rates now is very debatable. There is a case for cutting them. There is a case for not cutting them. And you can see that among many other places on the Federal Open Market Committee itself, which is greatly, sharply divided.
Alan, you hold that right there because it's a perfect entree. We now have Eric Rosengren's statement. He was one of the two dissenters who decided that he wanted to vote against the rate cut. We heard earlier from Bullard, who wanted 50. So let me tell you what Eric Rosengren saying, get your comment on it. This is breaking right now. He says additional monetary stimulus is not needed for an economy where labor markets are already tight and risks further inflating the price of risky assets and encouraging households and firms to take on too much leverage. While risk clearly exists related to trade and geopolitical concerns, lowering rates to address uncertainty is not costless. And guys in the back, I don't want to put pressure on you right now, but if you could put up the full screen with Bullard's points on it. He says inflation is low. He says we may already be near recession. So you have these two really opposing views, smart guys out there. Where do you come down, Alan? Is Rosengren right that there's this risk here of bubbles and pushing people into risky assets, or should the Fed be acting aggressively right now? There's the Bullard dissent explanation, which is honestly the opposite of what Rosengren's saying. So where do you come down, Alan?
Sure it is. I'm closer to Rosengren. If I was a dictator in deciding this, a fanciful idea, I would not have cut interest rates, either of the two, 25 basis points. But on the Bullard side, and this gives you a sense of why this is such a reasonable debate, I'd be watching very carefully for any signs of a downturn. We don't really see them now, but any actual signs of a downturn, and then I would fire away 50. I could imagine 2 50s in a row or something if the economy really looks like it's losing steam. But look, we've been on a kind of a 2% growth path, give or take, for a long time now. We still look to be on a 2% growth path, give or take. And that's what the forecasts say, by the way, including the Fed's forecast. So that's what puts me more in the Rosengren camp than in the Bullard camp.
So while there's no signs necessarily of a recession or a downturn ahead, the yield curve has been inverted for close to 4 or 5 months now. What do you make of that, right, and why is it different this time?
I think I don't make too much of it, and I think the reason it's different this time is mainly that around the world, and including in the United States, these aren't only foreigners, there's a rush to safe assets. There's a shortage of safe assets given the apparently abundant demand for safe assets. By the way, that has something to do with the repo issues that you were talking about a few minutes ago. And people are running into treasuries, which is, some people run to gold. That's not really a safe asset. More sensible people that are worried run to treasuries. And you got this tremendous demand for U.S. treasuries. The short end, of course, is more or less controlled by the Fed, and the Fed is now going down.
Becky,
it wasn't before, and you got the inversion.
Becky, Eric Rosengren has a chart. He's a chart guy. He always puts out charts in his dissent here, showing, he says, low interest rates are encouraging more leverage in underwritten, riskier debt transactions. And he's got a chart here of average total debt to the EBITDA multiple. It's now, I guess, approaching 6 and above 5. It's higher than it was in 2007 as a measure of the debt that's out there.
What's your run rate of the GDP growth the last 2 years?
It's been 2 and I just did it, 2.25, I think it's been the last over the Trump presidency.
Counting? All right.
Sorry, no, 2.6. It's been it was.
So why say 2? Why say 2 if it's 2.6, Alan? Just because it sounds better.
Well,
if you don't like Trump.
Well, I don't like Trump.
No, I know, but so you say 2, you say, we're still running at 2. So is that 30%? Is 2.6 30% higher than 2?
Okay. So what happened basically is we had about a year or so after the tax cut in which the growth rate bumped up to a bit closer to more like 3.
The sugar high. But that wasn't supposed to happen either, according to Larry Summers. We were supposed to grow at like 1%, and so I don't know. And the market's supposed to.
I don't know. Did Larry say that? I certainly never said that.
All right. Well, we'll see whether we are dealing with some headwinds now, obviously, but you don't know it's going to be 2% for this year and the next year.
All I was saying is that's where the forecasts are. Okay. They could be wrong.